They just lit the fuse again. In January 2026, silver didn't rally, it detonated, up roughly 65% in a single month, something this market has only printed twice in the last half-century. And every time that exact kind of month showed up before, the next chapter changed people's lives, in opposite directions. One time, it turned early buyers into legends. The other time, it trapped late buyers in a 5-year financial coma. Same signal, different ending. And right now, you're watching the third occurrence unfold in real time, while most analysts are staring at daily candles, missing the one thing that actually matters. The pattern the monthly chart is screaming. Welcome back. I break down market moves the way professionals actually trade them. Structure, history, psychology, and the trapdoors nobody talks about. If you want the follow-up analysis as this plays out day by day, tap subscribe now. Short, simple, and it keeps you ahead of the headline crowd. Now let's get surgical. Here's what happened. Silver printed a rare shock month, a monthly gain big enough to bend the chart into a parabola. That is not normal price action. That is not healthy. That is the market switching regimes, from rational to reflexive, where momentum feeds on itself and volatility becomes a weapon. And when silver enters this regime, you don't get polite pullbacks. You get air pockets. You get rip-your-face-off squeezes. You get days that feel like a bull market and a bear market in the same afternoon. So before you do anything, before you chase, before you panic sell, before you lever up because your timeline is screaming, "to the moon," you need to understand what this exact monthly signal meant the last 2 times it appeared. Because the next 60 days can define the next decade. Let me show you the setup in plain English. A parabolic move is when price stops climbing and starts launching. The curve steepens. The pullbacks shrink. Every dip gets bought instantly. It feels easy. It feels obvious. It feels like the market has finally woken up. That feeling is the bait. Because parabolas don't die slowly. They don't fade. They snap. And the snap is what separates life-changing profits from the kind of losses people don't talk about at dinner. So we're going to do 2 things in this script. First, I'm going to walk you through the 2 historical precedents: what happened, what the crowd believed, and what the market did next. Second, I'm going to translate those lessons into a battle plan for today. What zones matter, what behaviors get you killed, and what decisions keep you alive when the market starts throwing knives. And yes, there's a third piece most people ignore: the psychological war. Because in parabolic phases, the chart is not just a chart. It's an emotional extraction machine. It harvests fear and greed and converts them into someone else's profit. Let's rewind to the first precedent, December 1979. This is the archetype people remember, because it's dramatic, because it's infamous, because it taught an entire generation what a blow-off top looks like. Back then, the macro backdrop was a perfect storm. Inflation was hot, confidence in paper was cracking. People could feel the dollar bleeding purchasing power, and silver, already rising, suddenly accelerated into a vertical climb. In that 1 month, it surged by roughly the same kind of percentage we just saw in January 2026. And here's what happened next. The market didn't cool off. It doubled down. The next month came in like a second wave, another monster move on top of the first. That's the part people forget. The most dangerous phase of a parabola is not the start, it's the continuation. Because once you've had the rare month, the crowd assumes the system has changed forever. They stop thinking in probabilities. They start thinking in destiny. You could feel it in the tone. Everybody suddenly had a price target. Everybody suddenly had conviction. Every taxi ride turned into a metals thesis. And then the market did what parabolas always do when they run out of oxygen. It broke. Not gently, violently. The drop that followed wasn't a normal correction. It was a structural failure, like a bridge collapsing under a stampede. The people who bought the late stage didn't just lose money. Many of them lost time, reputation, and in leveraged cases, everything. And here's the scar that still matters today. That peak became a psychological wall for decades. Even when silver ran again years later, that old level acted like a ceiling made of steel because the market remembered the pain. That's outcome number 1. Rare month, follow-through surge, euphoria, then a crash so brutal it writes a generation of caution into the chart. Now, the second precedent. February 1974. Same signal on the monthly chart, one of those huge, historic months that almost never prints. And the crowd reacted the same way. They expected continuation. They expected a straight line higher. They expected fireworks. But instead of an immediate blow-off, the market did something quieter, and for many investors, even more torturous. It went sideways. Not for weeks, for years. Imagine buying after a historic month, feeling like you caught the beginning of something unstoppable, and then watching the market grind into a range so long you stop checking it. This is the kind of outcome that doesn't wipe you out in one day. It bleeds you out slowly. It kills your conviction. It makes you question your thesis. It makes you sell out of boredom, frustration, and opportunity cost. And then, after most people have given up, after the headlines have moved on, after the crowd has declared silver dead again, that's when the next major move tends to start. So you have two historical outcomes tied to the same kind of signal. One, a fast continuation into a blow-off top and a violent collapse. Two, a long consolidation that tests patience, followed by a later breakout that rewards the survivors. Same setup, two different traps. And now we're in January 2026 with the third occurrence. So the question isn't, is silver bullish? That's what amateurs ask. The real question is, which ending are we walking into? Are we in the 1979 script, where the next month adds another brutal leg higher and then punishes late chasers? Or are we in the 1974 script, where the market stalls out, chops sideways, and forces everyone to capitulate before the next launch? This is where people want certainty, and the market is designed to punish anyone who demands it, because nobody knows the top. Nobody. Not me, not institutions, not the loudest account on your feed. What we can do is map the probability zones and build a plan that survives both outcomes. So let's translate history into today's math. If this is the 1979 type sequence, the rare month is step 1. Step 2 is the follow-through month, the second surge that convinces the world the rules are gone. If silver is trading around the current zone after that January sprint, another 30 to 40% leg would not be fantasy. It would be exactly what parabolic continuation looks like. Run the arithmetic. A 35 to 40% push from around 110 puts you in the neighborhood of 150 to 160. And I want you to notice something. 150 to 160 is not just a random target. It's a psychological region where the crowd's narrative becomes absolute. That's where people stop saying maybe and start saying certainly. That's where new buyers show up not because they understand the trade, but because they can't stand watching it without them. That's where tops are born. Not because a number is too high, but because positioning becomes one-sided. When everyone is on the same side of the boat, the slightest wave flips it. Now, does that mean 150 to 160 must be the top? No. Markets can overshoot. They can stall earlier. They can top below targets. They can rip higher than anyone thinks and still crash afterward. The point is, if we get a continuation month, that zone is where the risk of a major exhaustion spike increases dramatically. And exhaustion spikes are treacherous. They don't announce themselves politely. They look like victory. The candle is green. The headlines are bullish. Your account looks great. And then, without permission, the market slams the door. That's why this phase is dangerous, because the emotions are strongest right before the reversal. Now, what if we don't get the continuation month? What if this is the 1974 type outcome? Then the market's weapon is not a crash. It's time. It's chop. It's a slow grind that makes you feel stupid for being early. And if that happens, the important question becomes, where is the structural floor that holds the next multi-year base? You've heard people dream about old prices, 30, 40, the good old days. Let me be blunt. In a structural regime shift, those levels don't just return because someone misses them. Floors ratchet higher as the market reprices scarcity, risk, and trust. So if this turns into a long consolidation, the market will likely defend a zone that reflects the new reality. Call it the region around 70 as the worst-case support zone people anchor to. Is it guaranteed? No. But it's the kind of level where, historically, fear peaks, weak hands dump, and patient capital starts accumulating again. So you have an upside continuation zone to respect, and you have a downside structural zone to understand. Now let's talk about the part that actually decides your outcome, behavior, because the chart isn't the only risk. You are. Parabolic markets do one thing perfectly. They bait you into buying strength with confidence and selling weakness with terror. Buy high because you feel smart. Sell low because you feel relieved. Repeat it 3 times and you're not just down money, you're down trust in yourself. This is why professionals don't wing it in a parabola. They operate with rules. Rule 1. You do not go all in the most volatile phase of the move. If you're building a long-term position, you scale, you average, you keep dry powder. You refuse to let FOMO dictate your sizing. Rule 2. You respect that leverage is gasoline in a fire. Leverage makes you feel powerful on green days, and it makes the market your landlord on red days. In these regimes, the market doesn't need to be wrong for you to get wrecked. It just needs to be volatile. Rule 3. You take the chart seriously when it starts rewarding everyone. That's a weird sentence, but it's true. When a trade becomes easy for the entire crowd, it's usually nearing a phase change. Because markets don't exist to make everyone rich at the same time. They exist to transfer wealth from emotional hands to disciplined hands. So how do you survive the next 60 days? You build a two-path plan. Path A. Continuation into the 150 to 160 zone. If price accelerates into that region, you don't wait for the exact top like a hero. You scale risk down. You trim. You de-risk. You protect gains. Not because you're bearish, because you respect the historical behavior of blow-off phases. Path B. Consolidation or sharp correction. If the market fails to continue, or if it snaps lower in a fast liquidation wave, you don't panic. You look at structure. You look at where the market is likely to find real bids. You consider scaling in where fear is loud and liquidity is thin. And here's the part people hate hearing. Both paths require patience. Patience to take profits when greed screams, "Hold forever." Patience to buy when fear screams, "It's over." That's the whole game. Now let's zoom into the volatility itself, because I want you to understand why the last few sessions felt insane. Parabolic phases create three overlapping forces. First, profit-taking. Big money sells into strength. They distribute to late buyers. That's why you see sudden red candles even in a strong trend. Second, liquidation cascades. When price drops fast, leveraged longs get forced out. Their selling pushes price lower, which triggers more forced selling, which accelerates the drop. That's why declines feel like elevators. Third, sentiment whiplash. Retail psychology flips like a switch. Green day, new paradigm. Red day, it's over. And that emotional volatility becomes the fuel for more volatility. If you don't understand these forces, you interpret every move as a new truth. If you do understand them, you see them as mechanics. Mechanics don't scare you, they inform you. Now, I want to press you on something. What are you actually doing here? Are you a long-term holder trying to preserve purchasing power? Are you a trader trying to harvest swings? Or are you an emotional tourist chasing a story? Because those are three different games. If you're a long-term holder, the daily noise matters less. You care about accumulation, custody, and the long arc of the monetary cycle. If you're a trader, you care about timing, levels, risk, and exits, because one wrong day in a parabola can erase months of work. And if you're a tourist, you're the one providing liquidity to the other two. So choose your identity before the market chooses it for you. Now let me give you a clean framework you can actually use. 1. Define your core. That's the position you don't touch, your long-term hedge. It's sized so you can sleep. 2. Define your tactical sleeve. That's the portion you trade. Trim into strength, add into weakness, without emotionally touching your core. 3. Define your invalidation. That's the level or condition that tells you your thesis is broken, not just uncomfortable. Most people skip step 3. They confuse discomfort with invalidation. And in volatile regimes, that confusion is fatal. Now let's talk about the two biggest traps that will appear next. Trap 1, the forever narrative. When price is rising fast, people start using permanent language. It can't go down. This time is different. The shorts are dead. Only up. That language is not analysis. It's a warning sign. Markets punish permanent language. Trap 2, the perfect top obsession. People see history, hear the 150 to 160 zone, and decide they will sell the exact peak like a sniper. That ego gets punished too, because blow-offs reverse fast. The top is often a single day, sometimes a single hour. If you wait for perfect, you often get trapped. Scaling beats guessing. Now I want to turn this back to you, because your answers tell me what kind of risk the audience is sitting in. Do you think we get the fast 1979 type continuation and blow-off? Or do you think we get the slow 1974 type stall and multi-year range? Drop one word in the comments: blow off or base. And here's a second question that matters even more. If silver spikes into the 150 zone, do you have a plan to take risk off? Or are you hoping your emotions will suddenly become disciplined in the moment? Tell me the truth in the comments, because your future self is going to read that answer like a receipt. Now let's address the elephant in the room. Prediction. People want me to call the top. They want a date. They want a number. That's not how real trading works. Real trading is scenario management. It's playing defense while you play offense. It's accepting you can't control the market, only your decisions. So here's what I'll give you instead: a map. If price continues aggressively, watch the zone where the crowd becomes euphoric and the move goes vertical. Call it the 150 to 160 neighborhood as the danger zone. If price fails and we see liquidation, watch for the market to attempt to build a floor around major structural support. Call it the region near 70 as the fear zone. Between those zones is where the game is played. And the truth is, even if we top, the story may not be over. The 1980 peak didn't end silver forever. It ended the parabola. The broader cycle still existed. It just took time to reset. That's the point. Parabolas are phases, not destinies. So don't marry a phase, manage it. Now, let me leave you with the one line you need to tattoo on your brain in this market. Your fear pays someone else. Your greed pays someone else. If you can control those two impulses, you're ahead of 90% of participants. If you can't, the market will educate you, expensively. So here's your action item. Write your plan today, not on the day the candle is screaming. Decide what you'll do if we surge. Decide what you'll do if we snap. Decide how much you can hold without panic. And decide what enough looks like, because more has no ceiling in a parabola until the collapse. If you want the next episode as this develops, levels, sentiment, what the monthly candle is doing in real time, subscribe. It's one click, short and effective, and it keeps you from trading this blind. We're living through a setup that has only printed twice before in 50+ years. Now it's printing again. And history doesn't repeat perfectly, but it rhymes loudly enough to hurt the people who refuse to listen.